The following is a presentation of 13ABC Action News. Now, your table is ready. Join 13ABC's Jeff Smith with the decision makers of Northwest Ohio and Southeast Michigan. This is the Roundtable.
And a happy new year to you. Thank you so much for spending some of your Sunday here with us on the Roundtable program. My name's Jeff Smith, and we've got Alan Lance with us. He is from Lance Global and registered investment advisor. You've been here before. It's good to see you again. Happy New Year to you.
Same to you, Jeff. Thanks.
I wanted to bring you on today, and we're going to get into a little bit of talk in our second segment today about the inauguration and a trip going over there to D.C. in just a couple of weeks. But with Alan here, I wanted to talk a little bit about just coming out of this fiscal cliff. And I know the Sunday morning talk shows have been talking about it and discussing it. But what was your read on the, I guess, the 11th hour workings that came through? And I mean, was the deal that was done good for everybody?
Well, I think it's good that they got something accomplished, but they're, pretty much kicked the can down the road on the spending side. So we'll have to see come February, what happens there. On the tax side, I don't think it was as draconian as it could have been, which is good. I think there's some pent-up demand in the economy, so it should slow down the economy, potential growth a little bit, but not as much to get us in a recession, which if we went off the fiscal cliff, that was a possibility.
When the initial estimates came out and when the deal was done, Wall Street reacted favorably, obviously, had a huge day, 300 points in positive territory. That was earlier this week. And then the next day, there was some unemployment news that came out that took the markets down a little bit. But things of this nature, and when, unfortunately, we seem to be in this uncertain pattern again going into 2013 because as we talked about, and you alluded to, the payroll tax increase for all Americans. They're going to see their paychecks a little bit smaller because of that little, I guess, stipend that was put in there in 2011 when we were going through the stimulus. But when you look at 2013 as a whole, and we've heard people say January is going to be a big month because it could be the bellwether for the rest of the year. What's your read? Is it going to be another kind of rock and roll type of roller coaster season?
Yeah, I think it will. I think you're going to have a situation where it's still going to be an anemic recovery. We still have the debt ceiling to approach, which I think is going to be more tedious than the fiscal cliff, and equally important. It'll be interesting this coming week when earnings come out to see what kind of expectations. But I really think they're going to be dampened. I'd be surprised to see more than a 2%, economic GDP growth as far as for 2013. Again, depending on how much they slash spending when they start addressing that next month.
Nobody can put their finger on if we're still in a recession or not. There have been all these statements that have come out that we're out of it or we're getting better. I mean, where do you think we are at this point?
Just anemic recovery. Typically, it feels like a recession because typically when you come off.
Still.
Exactly, because when you come off a major depressed financial state like we did in 2008, 2009, the recovery is 4 or 5, 6%. Unemployment goes down to 6.5%, where the Fed wants to get it. Yeah. We're not seeing those numbers. I mean, we're barely seeing any growth at all. The fiscal cliff situation is going to dampen that meager growth we had, even more so. But we did see some pent-up demand into November and December that we like. So where we took some profits end of the third quarter, early fourth quarter, because it was a good year, 2012, yeah, like you referred to, we bought, especially like income-producing companies, because they were depressed with the worries of the fiscal cliff.
It's been anemic over the last decade or decade and a half as far as the stocks are concerned. What are you advising people as far as they look at their investments going into this next year? I know in 2012 we saw a lot of individuals who were approaching that retirement age and decided, I am going to retire because there's too much uncertainty out there. What are you advising at this point?
Well, it's interesting, Jeff. I see more of what we had last year. Last year, the first quarter, we were up 12%. The second quarter, the markets were down. Third quarter, we were up 6%. The fourth quarter, the markets were down. So again, it's where you buy. And if you buy into weakness like we do, the average gain the last 3 years is 45%. If you buy into strength, meaning when the markets are above the 200-day moving average, The average gain in the last 3 years is 1.5%. So that's a 30-fold difference. And if you think it's going to be
better to be a buyer on those down days.
Oh, definitely. Like you mentioned earlier this week, when the markets were up, 4%
Not a good
over
day
2
to buy.
days. No, I mean, take some money off the table, reduce risk, and then buy when they start talking about the debt ceiling. You're going to have a lot of volatility. Use that volatility to your advantage. That's the best thing that your viewers can adhere to.
Let's talk about the debt situation and where we are, and we'll show people at home. This was effective of early this week, but there's a running. You can find these online anywhere, but there's a running debt clock that people can look at. We're sitting at 16 trillion in debt. What we're showing our viewers at home, and I'm interested in your take on why should we worry about this? I mean, you and I sitting here, Toledo, Ohio today, Northwest Ohio. Is that a big deal? Is that number in the scheme of things a big deal?
It's tremendous. I mean, I don't think the average person understands, as far as it was a major deal for President Bush to go from 8.2 to 9 trillion. We're over 16 trillion, adding a trillion a year. So that's where that spending side, which we kick the can down the road, really has to be adjusted. Now, you say it's a big deal. Next quarter, next few quarters, next year even, it might not be a big deal. But for our kids, our grandkids, these are debt levels that are going to be very hard to square away and become fiscally responsible.
I guess parlay that or compare it to when you talk about what other countries have gone through and when you look at debt situations, and I guess when it comes back to it, I mean, isn't the importance, or shouldn't the importance be on our GDP and how our country survives moving forward?
Yeah, and that's where this recovery, where, if we were growing 4, 5, 6%, like we talked about, a typical recovery, then it's not as much of a problem. But we're still adding to the debt, and the recovery is anemic. So I think it's a situation where, we do have to cut spending, and, I think the tax situation was well done, and I'm glad that was done. That was just one half of it, and then we've got the debt ceiling to take, care of as far as over the next month. And I mean, we talked a year and a half ago when they as far as downgraded our credit here in the United States on this show, and we could be running into the same situation if these things aren't squared away. So yeah, they definitely are important.
So when you look 2012 to 2013, mirror images, financially speaking?
Mirror images and buying on weakness and buying selectively and taking profits, when you have those strong periods as far as that goes. But it's a situation where there are not as many bargains. I mean, a year and a half ago, we were buying Google under 500, and some of the Fords and the GMs even were trading at new lows. They're hitting new highs now. So you need that economic growth now because the expectations are greater. So as valuations move up, there's more risk, and investors have to be aware of that.
What does it mean in the scheme of things when, and obviously we saw this during the campaign, and how much emphasis was put on the, I guess, rebirth, if you will, of the automotive industry, and especially here in Northwest Ohio, and knowing that we had a report that came out earlier this week talking about how there was a record-setting number of models which are going to be released, which means obviously these companies are feeling better about getting more product out there because they assume that there's going to be a buyer for that product. So there's almost, I think, 50 new models that are going to hit the market, and they want those buyers to buy, and they want these companies to do better. But how much does that play into, I guess, people feeling better about investing?
Oh, it's very important, Jeff. It's a situation where domestically there's pent-up demand, as far as that goes. That's going to help us. China, I think, is going to be a good source. China's growing more than people are expecting. So it's a situation where if things fall into place, we could have a good year in 2013. That was one of the reasons we're buying into the weakness and the worries of the fiscal cliff. But again, over the long term, we have to address those issues as far as the debt ceiling and the spending. We're not even barely slowing down the degree of spending, and we really have to turn that around where we're collecting more revenues than what we're spending, and we're we're talking about now as far as just slowing down the degree of the acceleration, which, is just going to get us into problem times. Again, not 2013, but down the road, and that's what you have to be aware of.
Are you, or your, I guess, comrades, are you surprised it's taken this long? It's been this slow?
Yeah, I think it's very negative. Just like with the as far as debt rating downgrade a year and a half ago. Didn't have to happen. It was a very poor situation. I think they learned from that. That's why we came to some kind of degree of agreement as far as New Year's Eve and New Year's Day. But it's still a situation where we're far away, and hopefully they'll understand the importance. And I think they're starting to. And it'd be good to see our folks in Washington do the right thing.
Lance and Associates, Alan Lance with us this afternoon. So as you go forward, and if we can give our viewers some free advice, what are probably 2 or 3 things they need to think about as far as being active in the markets or just active with their savings?
Well, I think a couple things is always look at the risk levels. I think everybody looks at what the performance or what a stock has done or what an investment or CD has done. Look at the risk you're taking. Don't go long term if you're buying bonds or fixed incomes or CDs, because interest rates will go up, if not this year, next. And then it's just a situation of, like we said, buy quality. You get those sell-offs, take advantage of them. Still a great country. I think we're in a good situation. We're just going to have some hiccups. It's not like the 90s where you can just buy anything and watch it and make 15-20% a year. It's going to take a tactical strategy of buying on weakness and letting go and reducing risk and strength.
Alan, as always, we appreciate you spending some time with us here on 13 ABC on the Roundtable. We'll see you next time.
Sounds good. Thanks.
Good to see you. Stay right there. We'll have more coming up here on the Roundtable program. Talk about some of those, I guess, who are really working hard to get people to our nation's capital for this year's inauguration right after this.